Futures traders, buckle up. We've entered uncharted territory where global trade isn't shaped by negotiation, but by one unpredictable man in the White House. Yes, Donald Trump's return has unleashed a tariff tornado, a whiplash trade policy that's shaking markets worldwide. Forget textbook economics or predictable policy cycles. We're now trading in an era where world-moving decisions drop on social media without warning. This isn't just about tariffs. It's weaponized economics. It's geopolitical chess with real money on the line. And for traders, this chaos isn't background noise. It's the market itself. How do you hedge when a 145% tariff on China appears overnight? What happens when the dollar's safe haven status is questioned, or when supply chains that are built over decades are intentionally torn apart? From commodities to equities, currencies to treasuries, every market is vibrating with this new volatility. We're seeing sudden shocks, reversals, and escalation that could tip into something far more dangerous. The question isn't if your portfolio will feel it, it's when and how hard. This isn't history repeating, it's history on steroids. For futures traders, understanding this new playbook isn't optional, it's survival. The big story: Donald Trump's radical second-term tariff offensive. He calls tariffs music to my ears, a way to make America rich again.
I always say tariffs is the most beautiful word to me in the dictionary.
The new playbook: go it alone, skip Congress, declare emergencies, impose reciprocal tariffs on a massive scale. And on April 2nd, 2025, dubbed Liberation Day, Trump launched his shock move: tariffs of 10% to 50% on over 180 countries. And by April 5th, they were active, hitting 71% of all U.S. imports worth $2.3 trillion. Average tariff rate, 27%, the highest in more than a century. And he didn't stop there. Secondary tariffs punished countries doing business with the U.S. rivals. India got slapped with a 50% tariff for buying Russian oil. Steel and aluminum tariffs doubled to 50%. A 25% tariff hit all imported cars, even from Canada and Mexico. And with China, a full-on trade war. U.S. tariffs at 145%, China retaliating with 125%. Even close allies like Australia got caught in the crossfire. This is America First economics weaponized, aiming to extract concessions, fix trade deficits, and supposedly bring manufacturing home.
We're also taking jobs and factories away from countries with poor environmental standards such as China, and bringing jobs back to America where they belong.
Some in the administration even floated replacing income tax with tariff revenue, an idea economists called mathematically impossible. And legally, it's quite messy. U.S. courts have already ruled parts of these IEEPA tariffs illegal, but they remain in effect pending appeal. That legal limbo adds another layer of uncertainty for traders and volatility for markets. The market reaction: pure chaos, followed by confusion, then bursts of optimism. Regarding equities, well, after Liberation Day, equity futures crashed. The S&P 500 down 4.88%. The NASDAQ was off 5.97%, one of the biggest single-day losses ever. Then, when Trump backtracked, pausing his reciprocal tariffs and capping them at 10% for 90 days, the markets ripped higher. S&P jumped 9.52%, its best day since 2008. Analysts even coined a new term: taco trade. Taco for Trump always chickens out. The idea: whenever markets panic, Trump backs down. That prescription has fueled record highs even as risks linger just beneath the surface. Regarding bonds, the bond market has been Trump's real match. When investors dumped Treasuries, yields spiked, forcing him to pause tariff hikes. The U.S. now faces a $2 trillion budget deficit, around 6 to 7% of GDP. The longest-term yields keep rising. Goldman Sachs notes long-dated Treasuries haven't rallied even as growth slows, suggesting their safe haven reputation is fading. Expect a steeper yield curve Short-term yields may fall with Fed cuts, but long-term yields stay high on fiscal worries. And for bond futures traders, that means navigating a volatile, shifting yield landscape. Now, regarding Forex, even the mighty dollar isn't safe. The dollar index plunged to 120 by mid-2024, its steepest first half drop since the 1970s. As confidence in the U.S. policy faltered, Goldman Sachs expects further weakness. Meanwhile, the Chinese yuan faces devaluation pressure. The Japanese yen, on the other hand, may strengthen if the Bank of Japan raises rates in October to combat tariff-driven inflation. For FX traders, this is gold. Volatility everywhere. Regarding commodities, copper spiked after a 50% U.S. import tariff. But analysts at JP Morgan see prices sliding back to around $9,100 per metric ton before year end. Aluminum tariffs doubled to 50%, freezing the U.S. Midwest market and rerouting shipments to Europe. Soybean farmers, burned once before, have cut planting by 50%, fearing loss of global market share to Brazil. And Brazil, in turn, diversified their exports to China and Europe after the U.S. slapped a 50% tariff on coffee, raising U.S. coffee prices 25%. And China, well, it's weaponizing its monopoly on rare earth exports. Critical for defense and tech, a major risk point for traders. And China? It's weaponizing its rare earth monopoly by curbing exports. And on October 10th, 2025, Trump hit back with a 100% tariff and threats to cancel talks with Xi. The trade war roared back, sending the Nasdaq down 3.6% and the S&P 500 off 2.7% as traders now brace for chaos. So let's discuss some of the macroeconomic headwinds. Inflation's rising. Tariffs are feeding inflation. Core CPI hit 3.1% in June, and economists see 3.7% by year end. That's roughly 1.5% higher inflation directly caused by tariffs, effectively a consumption tax on American households. Growth is slowing. Q1 2025 GDP dipped by about 0.5%, then rebounded 3%, mostly because imports collapsed, not because domestic growth surged. And Goldman Sachs expects only 1% GDP growth for the full year. Recession odds between 45 and 60%, depending on who you ask. Job market weakness. Manufacturing jobs are falling, 8,000 lost in May, 14,000 total by June. Stellantis laid off 900 workers, blaming tariffs. Modeling suggests up to 1.1 million total job losses, with unemployment potentially reaching 4.7% by year end. Now for the supply chain strain. Trump wants production back in America.
America will be a manufacturing nation once again.
But companies say it's unrealistic. Rebuilding supply chains at home takes years and huge investment, and many firms simply can't make that shift fast enough. How about the geopolitics and policy uncertainty? Well, we've weaponized trade. Trump's approach has alienated allies and pushed others closer to U.S. rivals. India, hit with a 50% tariff over Russian oil, called it unjustified. Modi has since pivoted towards China and Russia. This accelerates a multipolar world, with new trade blocs forming and flashpoints like Taiwan growing more dangerous. What about the chaos as strategy? Well, Trump's unpredictability may actually be the point. His on-again, off-again tariff threats have frozen global investment and paralyzed corporate planning. Executives are bracing for 4 more years of tremendous uncertainty. As one analyst puts it, the chaos is the policy. We also have central bank crossfire, the Fed's dilemma. Fed Chair Jerome Powell admits tariffs could cause a temporary but persistent rise in prices. And with growth slowing and inflation climbing, the Fed is staring at stagflation, its worst nightmare. Political pressure from Trump hasn't helped. He's openly demanded rate cuts and threatened Powell's job. In September, the Fed caved slightly, cutting rates 25 basis points, with 2 more cuts expected this year as the labor market weakens. Now, for the legal and political gridlock, the U.S. Court of International Trade already ruled Trump's tariff moves illegal, saying the emergency powers used didn't apply. Appeals courts agreed, but the tariffs remain while the Supreme Court reviews. So Congress could rein him in, but with Republicans blocking reform, uncertainty rules the day. So what's ahead for futures traders? One word: volatility. Inflation stays stubborn. Expect a 3 to 4% core inflation into year end. That means opportunities in inflation-hedge assets like gold, the tips, and selected commodities. But be ready for volatility and margin pressure. We'll get growth stalls and recession looms. Well, the GDP growth likely stays around 1 to 1.7% with 60 to 80% recession odds. For equity traders, go defensive. Hedge positions, short weak sectors, and favor companies with strong domestic demand. Expect a flight to safety moments when headlines turn ugly. The bond market is a safe haven no more. Expect a steeper yield curve, short yields down with Fed cuts, long yields up with deficits and debt concerns. A Supreme Court ruling on tariff legally could jolt the yields again. As for Forex, dollar weakness and volatility is ahead. Forex traders should stay nimble, hedge exposures, and exploit policy-driven moves. Regarding the geopolitical wildcards, tension around Taiwan, rare earth restrictions, and the new China-India-Russia alignment all threaten fresh shocks. Event-driven trading, from summit headlines to military posturing, will be critical. Tall risk hedging and volatility futures could be powerful tools in this climate. Here's the bottom line. Trump's second-term tariffs are more than import taxes. They're a global shockwave reshaping trade, inflation, and geopolitics. We're staring at persistent inflation, slowing growth, rising unemployment, and a market questioning its old safe havens. For futures traders, adaptability isn't optional. It's everything. We're trading in a world where policy shifts overnight. Tweets move trillions, and uncertainty is the strategy. So that means staying informed, managing risk dynamically, and thinking across asset classes like equities, bonds, forex, commodities as one interconnected web. We're living in an era of long-term multipolarity, an unstable, high-stakes system where the trade war might just be the opening act. And in a world of constant change, adaptability is the ultimate currency for futures traders. If you found this analysis valuable, hit the like, subscribe, and comment. And please, stay ahead of the chaos.